All right, welcome back. Let's talk about CDs, certificates of deposit. They're a great way to get some interest out of your cash. They're issued by banks, and let's go into a little bit more in-depth conversation about them. Like I said, CDs, certificates of deposits, are issued by banks. They usually sell for a par value of $1,000, and they pay you interest every 6 months. So when I mean par value is that you have to buy at least $1,000 worth to get one CD, and you'll get an interest rate, whatever the interest rate is, and they'll pay you back every 6 months, every year, depending on how long the terms are. So they're a way basically that you can loan your money to the bank and they pay you interest. They are sold with different maturity terms. So some mature and pay you back in 6 months. Some can be issued for 10 years and everything in between. Usually, the longer time that you borrow them your money, the more they have to pay you an interest, right? Because the longer you go out, the more risky that it would be for you to lend them your money. So, why do they pay you more interest the longer that you loan them your money? Well, let's say that you loan the bank your money for 6 months. Well, the chances of the bank going broke are not very high. In the next 6 months, they're probably not going to go bankrupt. But if you loan them your money for, let's say, 5 years, then, who knows what can happen in that amount of time. So, in general, the longer time that you loan your money to a bank, a government, a corporation, the riskier it becomes and the more interest that you should receive because you're taking more risk with your money. We've established on this channel that cash doesn't do anything for you except sit there. But, it's good for paying your day-to-day expenses and for an emergency fund. So we did a lesson on treasury bills, and they give you interest in the form of you getting a discount when you buy them. And CDs will pay you interest every 6 months, similar to a bond. So let's talk about the types of CDs that are out there. So we have regular CDs, which those are CDs that you can buy in a bank account. So each bank that you bank at will offer their CDs. So Chase Bank will offer Chase CDs. Bank of America will offer Bank of America CDs, and so on. So, and each of those banks will have their own rates that they offer. Obviously, they're competing with each other, so they'll probably be very similar rates. But you can only have a Chase CD in a Chase bank account, and you can only have the Bank of America CD in the Bank of America account. So you can't buy the Wells Fargo CD, even though they have a better rate and you bank with Chase, you can't get the Wells Fargo CD unless you go and open up a bank account with Wells Fargo. And this is where the brokerage account, this is where the brokered CD comes in to fix that. So you can have a brokerage account, whether it's a joint account with your wife or your husband, or you can have an individual brokerage account. And inside those brokerage accounts, you can buy what's called a brokered CD. And what that means is that you can buy the Wells Fargo CD and have it inside your Charles Schwab taxable account, or your JP Morgan self-directed account can hold the Wells Fargo CD and the Bank of America CD and the Chase CD, right? So brokered CDs inside of brokerage accounts means that you can buy CDs from all the banks. You can shop around and see what bank offers the best rates. And you can put those CDs inside of a brokerage account. That's what's called brokered CDs. And it's not limited to just taxable brokerage accounts. You can do retirement type accounts like IRAs, Roth IRAs, things like that. So you can buy CDs in all those types of brokerage accounts. And that's different from the bank CDs, right? Those are just the regular CDs. You can only own that bank's CD in that bank account. So keep that in mind. So who invests in CDs, right? Basically, someone is going to invest in CDs is someone who needs their money back in a certain time frame, and they're probably going to use that money for something. So, for example, someone needs their money back in 6 months to buy a car. They need it back in a year to buy a house. They can go and buy a CD, 6 month CD, 1 year CD, and get some interest on their cash. They know when they're going to get their money back. They know when they're going to get their principal, and they know when they're going to get their interest. So CDs are perfect for people who have short-term needs for their money, and they need it by a certain amount of time, by a certain date. So how do you make money on CDs? Basically, you make money on CDs by getting interest that you lend to the bank. So you give them $1,000 for one CD or $10,000 to buy 10 CDs, and they'll give you a certificate saying that you deposited $1,000 with them, right? A certificate of deposit. And it says that they're going to pay you a certain amount of interest. So, but I mean, you don't actually get a certificate these days. Everything's done electronically, but the name still stands. Certificate of deposit. They kept the name. So let's go over the pros and cons of certificates of deposit. One of the pros of certificates of deposit is that it is a predictable source of income. You know how much money you lent them. You know how much interest they're going to give you. You know when you're going to get the interest. You know how much principal you're going to get back. And you know when you're going to get back that principal. So very reliable. Oh, of course, make sure you make sure you purchase the CD from a reliable bank, right? That you know is not going to go out of business. Some of the cons are reinvestment risk. So reinvestment risk is the risk that when you get your money back in a year or 6 months, that rates are lower. So now you have to reinvest your money at a lower rate. And that leads to the next risk, which is inflation risk. Inflation never stops, right? And its average is 3% per year. So let's say you reinvest your CD and rates fall. Rates are 2% in the market for the next year. And inflation was 3%. Well, you're losing 1% in purchasing power. And then in another year, let's say rates fall again to 1.5 or 1%. So now you're only making 1% interest on your CD, and inflation is still 3%. So now you lost 2%. So over long periods of time, inflation really erodes at the value of your money, at the purchasing power that you have. So not a good idea to purchase CDs for very long periods of time, especially with money that you could have put to work in other assets like real estate or stocks. So that leads to the third risk here, which is default risk. So remember when I said try to lend your money to banks that are reliable, right? You don't want to lend your money to banks that are going to go out of business or that don't have FDIC. They're not members of the FDIC program, because the bank goes out of business, you're not going to get your money back unless you have FDIC coverage. Make sure you know what the FDIC limits are, how much money you can get back in case the bank goes bankrupt. And then again, try to pick larger, more reputable banks. You might get a little bit of lower interest rate because of that, but your money's not at risk. But in general, how risky are CDs? How risky are certificates of deposit? So they're not going to be as risky as stocks or bonds, because stocks, obviously, they're corporations. You put your money in a stock, you don't know if it's going to go up in value or it's going to go down in value. You just don't know. With bonds, you're loaning your money to a government, a corporation, or a local state government, something like that. Usually, those are safer than stocks, right? You know that you're going to get your money back. But in the meantime, if interest rates go up, then the value of your bonds can fall. So CDs, you're borrowing your money to banks, right? So you want to make sure you borrow your money to reputable banks. It's a little bit riskier than putting it in a money market because CDs can range from 6 months, a year, 5 years, or longer. And the more time you put your money out there, the more risk that you're going to have of not getting paid back. And money markets are 90 days or less. They're short-term debt instruments, so that's why they're safer than CDs. Treasury bills, you're lending your money to the United States government. They are considered the risk-free investment. If you haven't seen the video that I did on treasury bills, you can go and watch that. I also did a video about money markets as well. And then cash, obviously, your cash is not going to change in value. $1 in your pocket is going to be, it's still, you're going to pull it out, it's still going to say $1. It's not going to say 70 cents. You're not going to lose 30% like you can with stocks. Also, CDs are covered by FDIC insurance. So that's another thing helping your CDs. Bonds are not covered by FDIC insurance. All right, so far on this channel, we've covered investments like stocks, bonds, and now CDs, money markets, treasury bills, and cash, all four of these which make up the asset class called cash. So we've gone over stocks, bonds, and cash. Next, we're going to go ahead and start talking about another asset class that you can invest in, which is commodities. So join me in that next lesson, and we'll see you there.